Well, do you have a long term care game plan? Today we're going to take a look. Well, have you considered long term care insurance? What is your game plan in the event that you do need long term care? Long term care specialist Casey Van Sice is my guest today to tell us what we need to know. Casey, welcome to Prudent Money.
Thank you so much, Bob. Pleasure to be here.
As far as insurance goes, people will consider life insurance. They'll worry about the health insurance. Not much thought though is put into long-term care, and it is a risk that we're going to be facing. I think a lot of it is lack of education and lack of education on options.
Well, Bob, I think you're right there. There's a lot of misinformation out there, and people might think that they're actually already covered with their health insurance plan, or that the government's going to step in and take care of them with Medicare, Medicaid. But right now, we know that those who are turning 65 today have a 70% chance of needing long-term care at some point in their lifetime, yet less than 10% of seniors actually have a long-term care policy, most likely because they're assuming that it's covered when in reality it may not be.
Well, let's talk about a few of the details of how these policies work. First of all, how do you even qualify for long-term care?
So long-term care insurance benefit will be triggered by either the inability to perform 2 out of 6 of the regular activities of daily living, which are eating, bathing, toileting, transferring, dressing, and continence, or for cognitive impairment such as Alzheimer's disease.
Well, what age should someone really start thinking about long-term care?
The earlier the better. Similar to life insurance, the younger you are when you set up your policy, the lower the cost is going to be. We have folks who are even as young as 40, if they have the means, can address that concern and save dramatically against someone, say, waiting till they're 65 or 80, to set up a plan.
Obviously nursing home care, even home health care is extremely expensive. But specific to Dallas-Fort Worth area, what is the average cost?
Well, the average cost, it depends on where you're receiving that care. Most people prefer to stay in their home if they can, and they will stay in their home as long as possible, as long as their means allow them to do so. The average cost in-home is about $45,000 a year. An assisted living facility is kind of considered the next level of care up. If staying at home is not an option, it's a similar cost, $45,000 to $50,000 a year for assisted living in our area. A private nursing home room, the price goes way up, anywhere from $72,000 to $97,000 a year.
Yeah, those are real numbers too. And what's interesting, I was surprised to learn that the average stay at a nursing home is not as long as one would think.
That's very true. Nursing home, as we kind of just mentioned, is kind of the last phase. Most people will try to stay at home as long as they can, or maybe move into assisted living. Nursing home is really kind of that last phase where the most advanced level of care is going to be needed, and that's part of why the stay in the actual nursing home facilities is shorter. Statistically, if you look at the largest claim-paying long-term care insurance company, they say that a nursing home stay is 42% of claims are for a year or less. Okay,
wow.
But for those who last beyond a year, the average is about 3.9 years. Call it 4 years if you survive past a year in a nursing home. Now, for those who are 65 or older today, statistically we know about 20% of those people who do need the care will actually need care for 5 years or more. So the problem with the averages is that, of course, if I'm standing in a bucket of ice water and my hair's on fire, then on average, I'm pretty good. But there's extremes to those situations, and the care could be needed for a significant amount of time, or it could be a very short amount of time. But there's no way to know for sure.
Well, of course, when you get a long-term care policy, you have the option to choose the length of coverage. What should you be considering based on these stats?
Well, most people will kind of use that 4-year estimate and will buy a plan for coverage between 3 and 4 years. When they're determining what kind of plan really fits their budget, the two drivers of the cost are the duration of time that you want coverage for, or the monthly benefit amount that you want to receive. So, if someone wants, usually a 2-year plan with a nice monthly benefit based on today's average cost is probably going to get the job done for most people. If they really want to be very prudent and conservative and plan for the worst, then there's even lifetime benefit plans that are available today.
Now, what are you seeing as to the annual rise in costs?
Well, over the past 5 years, it's actually been surprising in the industry. It's been about 2.5%, which is a little bit less than what's expected going forward. We're really expecting about a 3% probably increase in cost of care going forward.
Of course, with life insurance, premiums are locked in for the term. If you're using term insurance, what about long-term care? Are premiums locked in, or can they go up?
Good question. It really depends on the plan that the person wants to choose, because you can go anywhere from a paid-up policy. You write a single check, and your entire policy is paid up at once, or you can go with a monthly premium, kind of like paying for your car insurance, and pay as you go. Some plans have guaranteed premium, so the premium can never go up. If there's some of the more new age, linked benefit plans. The more traditional long-term care plans, if you're just trying to, pay the lowest amount possible, just like, say, a Medicare supplement, the rates can go up in the future if you choose that type of policy.
Now, when you buy a long-term care policy, you have the option to insure against the rising cost of health care. Talk about how the inflation riders work and the options that you have.
Right. So especially for those who are setting up a plan at a young age, they're planning ahead. An inflation rider, anywhere from 1% to 5%, is available, to increase that monthly benefit to keep up with the pace of the rising cost of care. Now, the older the individual is when they're actually setting up their plan, the less advantageous the inflation is and more costly it is. So typically, if someone is 60 or under, we very often recommend inflation. If they're 70, 80, it might be cost prohibitive, but of course in the planning process we help figure out what's the best fit for the budget.
Now, these policies have all types of bells and whistles and do different things. One of the features that some companies offer is a cash option. Talk about how that works and how that could be an advantage.
Absolutely, Bob. The cash option is the best benefit of it is that you can use the funds from the insurance company to pay a family member for care or for an informal caregiver, i.e., someone who's not a licensed nurse. So that's the biggest advantage of a cash benefit. Most long-term care plans, if they don't have a cash option, then they are simply reimbursing you for actual expenses, and it requires the services to have been provided by a licensed caregiver. So a lot of folks have kids or maybe a grandchild who is very hands-on, wants to be there for their grandparent or parent. If you have a cash option, it allows you to actually compensate that family member for their time away from their job or their other family responsibilities. So it's a good benefit.
Well, yeah, it sounds like it. One of the other benefits of a long-term care policy is that the non-forfeiture benefit. Talk about how that one works.
Yeah, so a non-forfeiture benefit is built-in protection that in the event that you cancel your policy, maybe something happens and you can't pay your premium anymore. You decide to cancel the policy. The non-forfeiture benefit basically turns the premium that you've paid up to that time into a pool of funds that you can still use if you do need long-term care. So even if you cancel your policy, you can still get, the premium you put into it back if you do actually end up needing care.
Obviously long-term care insurance is not cheap, especially if you're in your 60s and you're kind of getting a late start on planning. Talk about some creative ways that you could still get coverage, but maybe reduce the cost a bit.
Of course. Yeah, if you're wanting to, save some money on that insurance, then, buying a shorter coverage period, talks about maybe a 2-year coverage period is one way to do that. That's going to lower the cost. You can also, plan to co-insure, maybe say if the average cost a month is $6,000 for the private room in the nursing home, I'm going to only buy insurance to cover half that, and I'll pay the rest out of pocket, especially if you have existing guaranteed income streams in retirement, pension, Social Security, annuity income, that type of thing. You may already have a significant income there, and you might not need a policy with a full $6,000 benefit. So that'd be one way to do it.
I was just thinking, Casey, that if you're going to look into long-term care insurance, you really got to get connected with someone that is going to sit down and take the planning aspect of this seriously, because there are ways to reduce the cost. There are ways to co-insure, as you say, and you definitely want to make sure that you're looking at all your options so that you're not paying too much for this.
Absolutely right. You don't want to overpay for more than you need, but you want to make sure that you have at least enough for the expected cost at a minimum, and definitely working with a planner who understands your full financial picture is very important there.
Now, there's some real advantages if you own your own business, and I don't think a lot of people know this. This is something where you can actually have the business pay for it. Talk about how that works.
That's very true. Now, it's going to be specific to the type of business that you have, and you'll want to talk to your tax advisor about your specific situation. But one of the biggest advantages for certain business owners is that the premiums they pay for certain types of long-term care plans can be fully tax deductible. They can actually set up policies with full discrimination, meaning that you don't have to buy a long-term care policy for every employee. You can pick which ones you want. You can also buy a plan for your spouse if you're a business owner with business funds. So there are a lot of advantages, especially for business owners.
Now, obviously, you go through the application process, and they're going to evaluate your health and make sure that you're a risk that is worth taking, the insurance company. What are some health conditions that probably would not get accepted for long-term care?
So good question. There's, and today there's a very broad spectrum of types of long-term care policies available. We actually have plans that allow us to provide protection even if someone is completely uninsurable for traditional long-term care. They might actually qualify for an alternative plan. But if we're talking about traditional long-term care, the risk to the insurance company is based on your morbidity. In other words, the odds of you actually needing some care. So arthritis, mobility issues, such as like rheumatoid arthritis, anything that's going to cause you to need assistance to move around, like a wheelchair, walker, things like that, are going to affect the qualification for a normally underwritten policy. Any memory issues, histories of memory problems, head injuries, things like that, autoimmune disease issues, can also lead to significant need for care down the road. So those are some things insurance companies are looking for some of those underwriting plans.
Now, for those who don't have traditional long-term care insurance, there are other options, as you were talking about. Talk about, though, what it would look like if a person were to self-insure.
Right. So if someone was to self-insure, we kind of talked about earlier the, in our area, $72,000 to $97,000 a year for a private nursing home, per person. So if you're an individual and you assume, an average claim, 3 to 4 years, and you want to set aside enough cash for that, if you round that off to $100,000 a year, you're looking at about $400,000 of your own cash that you'd have to set aside if you want to self-insure, for one person. For a couple, double it. It's going to be about $800,000. Statistically, females, women live longer, and they need care for longer periods of time. So, and that sometimes is part of the decision process for a couple is, you want to potentially put more insurance on her, knowing that she may need care for longer. But the problem right now, Bob, is that we know And you can go to longtermcare.gov and see all these statistics, but less than one-third of folks who are 50 or older are actually saving for this risk. They're just, ignoring it.
Now, you mentioned Medicare a little earlier in the program. How does that fit into the equation?
So that is, one of the misunderstandings about Medicare is, Medicare is health insurance. It's going to cover hospital, stays and things like that, but it does not cover long-term care, which is, again, the inability to perform 2 out of 6 activities of daily living or cognitive impairment. Doesn't mean you're going to need to be in a hospital. It means maybe you can't cook for yourself or clean for yourself. And that is where the bulk of the long-term care cost is having someone come in to assist with those issues. So Medicare is not going to cover that. Medicaid, which is the safety net, for impoverished people, will pay for long-term care. But in order to qualify for Medicaid, you basically have to be financially destitute, with very little savings left, or you can't have too much income that you're receiving each month that can disqualify you there. So,
well, let's talk a little bit about insurance companies are thinking out of the box, putting these alternative plans together. There's one that's called asset-based long-term care, where a person could reinvest a lump sum of money into a policy that will create a long-term care benefit as well as a life insurance benefit. Talk about how that works.
Yeah, those are definitely the most popular plans right now. And an asset-based long-term care policy covers more than one base, at once. As you said, it's going to have, if it's a life insurance combination policy, it's going to have a tax-free death benefit to the family if the person passes away. It's going to simultaneously, turn that lump sum of money into a much larger pool of funds that's available to pay for long-term care. Also, that would be tax-free when it's received. For example, I have a young lady about age 60, purchased a policy for $100,000, and that provided her with over $600,000 worth of long-term care funds instantly.
There's another option by using an income annuity. Talk about how that works.
Right, especially for those who, have not planned for long-term care. Maybe they're in a facility right now. They never purchased that long-term care policy and they're paying out of pocket. They did the self-insurance thing. Or a child who has a parent who's in that circumstance. You can use an income annuity to guarantee that long-term care expense is paid for no matter how long that patient lives. So you can basically take, a single sum of money today, and the older that person is, or the more severe their care needs are, the higher the income that's produced from the annuity. For example, if the normal payout from the annuity is 14% for life, then but they're ill, then it can pay out more like 20 or 25% on the dollar for life. So you're able to convert a lump sum into an unending income stream, and that will really provide some protection, especially if the person has longevity.
Well, Casey, I really appreciate you coming on the program. This is great information. I think that the listeners have learned something today, and really do appreciate you coming on the program.
I'm happy to be here, Bob. Thanks so much.
It's interesting to hear some of these stats of how many people actually have long-term care, and the fact that this is a real risk. One of the things that you do in the financial planning process is you work towards creating financial independence. And and I always define that as the day that you can it's a choice to earn an income. You're either going to, right now we have to work, we have to earn an income, but you get to a point to where you've built up your assets, you've built up your investments, that now that can replace your income, and that's financial freedom. And so we always want to look at, okay, We've got that aspect of it done. Now, what could ruin retirement? And it's long-term care, any kind of an illness, a disability that forces you to go into a home. And fortunately, the insurance industry has really done a good job at getting creative and building some real good programs that a little bit more cost effective. But we talked about at what age is a good age to be looking at. I would say in the 50s, and that's really when I would encourage you to start to really thinking about it. It's still, obviously, as Casey said, the younger you are, the less, the smaller the premium. But I've talked to so many people who've gotten into their 60s where it does cost a lot more, and they've kind of regretted not having that taken care of back in their 50s. But, there are a lot of creative programs, and I want to stress once again, there's a lot of advisors who will just sell you a policy, but you need to spend a lot of time on the front end with somebody that's going to go through the process, the planning process, look at your assets, look at what kind of income you have coming in. For instance, it might be that you have from various programs, maybe $6,000 of income coming in. It might be that you put a game plan together that you're going to self-insure with $3,000 of that $6,000. Your spouse could still be okay, and you're going to do another supplement of $2,000. Or there's just a lot of creative ways that you can do it. I think that the bottom line is simply this: is that you've got to have a game plan. You've got to be able to answer the question: if this were to happen at that time in my life, what would I do? And the other thing that I've seen adult children do is you may have 2 or 3 siblings and concerned about long-term care for your parents, and I've seen to where they have pitched in money and either helped purchase the policy or actually bought the policy for their parents. But it's just definitely, it's something you don't want to ignore. And it might be that you've decided, well, I'm going to self-insure the whole thing. I've got the means to do it. Then that's fine. Just make sure that you've checked that box that, this is what I'm going to do. I've talked to, through the years, I've talked to so many people who've not been prepared for it. And I've talked to people who have been prepared for it, and they're just so grateful. I know that when my dad passed away, I took out a long-term care policy on my mom, and we held that policy for 10 years, had the inflation rider on it, and when she finally, she had Alzheimer's, we put her in the home, that policy with that inflation rider paid every single penny of that cost for 3 years. And I know that that's something my brother and I would not want to have to tackle, because it is expensive. Even back then, 10 years ago, it was something like $4,500 a month. So just something to consider. This is Bob Brooks. If you got a question for me, go to the website, www.prudentmoney.com. Have a great rest of the day.